Hi, in this video, we will see why past year's average profits are used in valuation of goodwill, why adjustments need to be made to the past year's average profits, and we also have a look at a table showing the adjustments that have to be made to past year's average profits. So let's have a detailed look into these items. Now the buyer of an organization would like to use future profits as a base while calculating the goodwill of the organization. So the buyer would like to pay goodwill based on what future profits he expects. The average profits of the past years is used by the buyer as a benchmark while estimating the annual future profits expected. And why are these average profits used? Average profits of the previous years is used by the prospective buyer because past profits is an indicator of future performance and future profits. So when the buyer of the organization wants to pay for the future profits which he will get, he will use the past year's average profits as a base because the past profits is an indicator of future performance and future profits. Now, while the buyer takes past year's average profits as the base, a few adjustments have to be made. Now, we need to make adjustments to the past year's profits. The reason is because the buyer of the organization is using the past year's profits to indicate the future profits that he would get. And if such profits of the previous years has been colored with an abnormal loss or an abnormal gain, it is only prudent to add back such abnormal loss and deduct any abnormal gain. This is why adjustments need to be made to the past year's average profits so that we can get the future profits. And how do we arrive at the normal annual future maintainable profit? We'll begin with the things that need to be added back. All abnormal losses needs to be added back. Examples: loss by fire or theft, loss on sale of fixed assets and investments. Also, overvaluation of opening stock and undervaluation of closing stock needs to be added back. If any capital expenditure has been wrongly treated as revenue expenditure, it would go to decrease the profits, so such amount has to be added back. All non-recurring expenses, such expenses which is not expected to occur in the future. Since they are not expected to occur in the future, to arrive at the future maintainable profits, we need to add back such non-recurring expenses which have affected the past year's profits. Next, we'll go on to the items that need to be deducted. Abnormal gains such as gain on sale of fixed assets and investments, appreciation in the value of fixed assets needs to be deducted. Undervaluation of opening stock and overvaluation of closing stock needs to be deducted. If any revenue expenditure has been wrongly treated as capital expenditure, then this has to be deducted again. Non-recurring incomes not expected to arise in future. Since we are trying to find out the future profits, all non-recurring incomes which has occurred in the past have to be deducted while arriving at the future profits. And in case any remuneration to partners of the firm has not yet been deducted, the same has to be deducted to arrive at the future maintainable profits. So in this video, we learnt why average profits of the past years is used by the buyer in the valuation of goodwill, Why do we need to make adjustments to the past year's average profits? And what are the adjustments to be made to past year's average profits to arrive at the future annual maintainable profits? In the upcoming video, we will see the difference between simple average and weighted average by means of an example.